Welcome to Picture Perspective. My name's Jordan Kennedy. Today we have Cameron Curko, our Chief Investment Officer, to talk all things markets, where we're at, bombs, tariffs, wars. Let's get cracking.
Thanks, Jordan. Let's go.
Before we kick off, a reminder, this is general advice in nature. Should you wish to seek personal advice, please reach out to your advisor. So Cameron, the hot topic last time we caught up was the tariffs and the timelines and all those sort of things. You know, over the last couple of weeks, I think we've lost sight of the deadline that Trump has set of the 9th of July. What can you tell us? What insights have you got?
On the trade front, it looks like we've only got the one deal so far with the UK. And to be honest, UK is in a trade deficit situation with the US. So that was always going to be a bit of a nothing burger of a deal. With regards to Australia, potentially we'll see something like that in time for the deadline or in the aftermath. But with Australia, it's again a situation where we're in a trade deficit with the US, and quite frankly, our relationship with them in terms of trade matters far less than our relationship with China. That's the big sort of gorilla in the room, if you will, regards to us. So to the extent that US-China relations are still frigid, that might have flow-on implications for ourselves. With regards to the president, what I suspect might happen is he'll either have a mix of some face-saving trade deals, or he might just extend the suspension again. It's a volatile presidency, and I think really you just got to roll with how he goes.
And are we seeing potential for volatility be as much as what we had when it initially kicked off, or the trade war kicked off? Or do you think we've lost a little bit of momentum with, you know, wars and other distractions that are going on, and people have sort of, and maybe even Trump has pushed this to the side and not focused on it as much as what he should be coming up to the looming deadline? I
think the shock value of his presidency has softened over time, and we saw that in Trump 1.0, if you will, when he started off with a ban, but then gradually markets increasingly discounted his impact. And I think we've seen that now, like relative to where we were on sort of April 2nd to the 9th. Markets are just discounting his impact increasingly. That doesn't mean the economic damage isn't underway already. It just means it's taken time to pass through the numbers. And what we've seen is the administration is very nimble, and where it thinks it might get a lot of consumer outcry. So, for example, Apple Electronics, magically we get an exemption overnight. So I think from that sense, what we're really seeing is sort of buy the dip mentality, because we don't ultimately think markets collectively that the president will follow through on his most extreme threats.
Let's traverse into war. Obviously, we've talked about the trade war or tariff wars, but let's talk about the real wars. Obviously, we've seen a lot of tensions escalate. We've seen oil prices go erratic. We've seen currencies move around. How is that affecting markets, and what view do we have there?
Yeah, so I think with the geopolitical conflicts, again, it's really a case of people are trying to price in what they think the sort of near to medium term impact of, say, the Israel-Iran conflict might be. And with regards to that, the real looming threat, just because, for context, these countries are thousands of kilometres apart. Like they can't just simply send troops into each other. So the possibility of inflaming tensions, you discount that somewhat. The big looming risk would be if Iran did something to disrupt oil flows. And for Iran, that is a nuclear option, and it's one that they've been very hesitant to actually even actively explore, because they're conscious of just the amount of blowback they'll get, not just from Israel, but also from the US and other players as well. And so once markets got a bit more confidence that the Iranians weren't going to sort of push the red button, if you pardon the colloquialism, we've seen really just a resumption of business as normal. Oil prices have retreated dramatically from where they were only a few days ago. And instead we're focused on big tech and buying up growth, and markets just continue growing higher this year.
And is there anything else on a global scale that we should focus on or have a lens on that may be on the horizon?
I think so. A few things. Really, when we look at the global market backdrop, what we're seeing is a situation where policymakers have been substantially supportive. We're seeing governments look to increase their deficits in the case of the US, Europe too, with some sizable defence commitments. And so on that sense, look, there's going to be a lot of support for the global economy coming through, and we're seeing central banks follow through as well with just as a collective, rate cuts are very much the main option on the table, bar one or two exemptions. So these are all things that are pretty positive for financial assets, and it's arguably not too surprising to see things grind higher. I think in terms of looming on the horizon, probably two factors. So one is the size of the US deficit and the negotiations around that. Typically, there's a lot of noise around that. You're going to see heaps in the paper, I'm sure, if we get even close to the deadline. But typically, at the end of the day, with some concessions, a deal gets done. And so I think for the most part, it's one of those, you just look past that noise. The second one is just how much damage is being done on the trade front. And that's something that is going to take time for us to sort of pass the numbers and see it flow through. Because for context, Trump imposes a tariff on washing machines, say. Businesses have already front-run some of that. So inventories are heaving in a lot of these warehouses in the US. So it's going to take time for a lot of that to pass through in terms of US inflation, in terms of the consumer impact as well. And that's going to be sort of the lurking risk. Tariffs are a tax. Like, ignore whatever Trump and his administration might say. They're a tax on the consumer. And to the extent we see the US consumer really impacted, that's going to be a potential left field risk in the second half of this year.
Great. Cam, let's move to home. What about in Australia? What are the key things we're looking at? Obviously, one thing that I want to ask, or I'm dying to ask, is interest rates. What's our view? Where are we tracking? I'm sure everybody wants to hear our perspective on that.
Yeah, so on the interest rate front, let's start with what does the RBA care about at the moment? So on the one hand, for the RBA, labour markets are tight, so underlying sort of growth conditions are okay to improving from their perspective. They're a bit worried about what's happening globally on the trade front, but more or less they're not overly concerned about the sort of growth trajectory of our economy. So that's growth. Now, on inflation, arguably you're seeing more and more signs of them being willing to declare almost a mission accomplished, if you will. And now they're arguably more worried about disinflation. And in that scenario, they've come to the table already with some rate cuts to start this year. And we think they're just going to follow through on that, in line with the consensus numbers, because we are seeing disinflation flow through, as you can see in the chart displayed on both goods and services. That inflation shock we had has well and truly abated. Now, the important risk with that, however, is a big part of that has been due to two things. So one, oil prices have cratered in recent months, so that's been a big help to bring headline inflation down. The other factor has been government intervention, so our utility bills. We just had recently the New South Wales and Queensland budgets. The states aren't coming to the table to help us much anymore, and the subsidies we've got federally, they're also winding down as well. So what we're going to see come through, and some of you might have seen this announced, electricity prices are going higher. They should arguably be sort of 18 to 20% higher than what they are currently. And so that's going to be a hit for the consumer.
But aren't we seeing some funding and some subsidies for solar panels, batteries, at a different level?
We are, but that's more sort of at the margins. For the average household, look, some might benefit from it, but that's more of a protracted sort of gain, if you will. In terms of the immediate, you at the hot seat, what you see when the bills come through, you're going to see electricity prices rise like decently from these levels. And that's going to be something the RBA has to be willing to look through. But the good news is the consensus is they're going to. Now, the question of how much they ease is probably a bit more open-ended. What we're seeing in markets and consensus forecasts is sort of between sort of 2 to 3 rate cuts by sort of early next year. And then people are expecting the RBA to hit the pause button just because you're going to have some of these inflation upside factors flow through. And the other reason is they're not concerned enough about growth. So if we rewind, it feels like a long time ago, pre-COVID, we were in a low growth, below trend economy. And until the RBA thinks they're confronting that, I think it's going to be harder to see rates materially fall from there. The only other upside, if you will, for interest rates would be if we see like global sort of tensions or trade conflict really escalate, and then the RBA might intervene with even a surprise cut.
Excellent. Ken, we've seen CBA all-time highs. We've seen, one of the first IPOs in Virgin coming to market recently. Talk to us about specific stocks and things that we're watching and monitoring that space.
Yeah, so the Australian market really has been a doozy this year. We're on track both domestically and internationally for double-digit gains, which I don't think any one of us would have thought, particularly during the height of the volatility in April. Now, why might that be? I think likes of the banks to start with are really benefiting from a sort of safe haven trade. It's like, okay, we've got all this stuff happening offshore. That's really hurting our miners, particularly China's property sector still languishing somewhat. So where do you park your money? CBA is the best bank in the country by many measures. So that has been where a lot of the flows have gone. And you've also got complications in terms of regulation and like where industry funds have been shifting more to passive. And again, that's just another wall of money potentially that's flowed to CBA as our biggest index constituent. So in that sense, it's actually been pretty rosy for markets, but I would say it's been a very concentrated trade in a few sectors. But I think it's just a reflection our market's very small in terms of if you put on a list the high quality names you can access in Australia relative to overseas, it's quite limited. And so when you've got a lot of money here, our super pot is gigantic.
It's only getting bigger. 0.5% increase in from 1 July. So that monthly buying or dollar cost averaging from super funds into the Aussie market is also going to continue to push.
Absolutely. It seems relentless. And the good news is the IPO market opening up, it might actually see smaller companies catch a bid. They've been somewhat languishing of late. So that might be a sign things are starting to turn around and be really good for some of these private market operators as well that have been sitting on some of these companies and wanting to IPO. We saw GYG last year, Virgin more recently, and there are a few other options as well. So it's a sign of, I would say, healthier markets, the fact that businesses are willing to actually go public again after a period where the IPO market's effectively been frozen, both here and overseas in a major way.
Excellent. Well, Cameron, thanks again for your time. Really appreciate your insights and perspective. We look forward to catching up with you again soon.
Thanks, Jordan.
Cheers.
Cheers.